If you believe the deathly silence of global markets following the US raid on Venezuela represents peace, you might already be the blindfolded sacrificial lamb being led to the altar. Why does the world's most sensitive, most cynical trillion-dollar capital behave like a catatonic patient when faced with a black and white event capable of altering national destinies? Do you truly believe that Wall Street traders, whose instincts are sharper than a shark, simply overslept? Or is it that they are sitting in a building that is already on fire, but hasn't yet sounded the alarm, elegantly counting their chips while waiting for the deadline that locks you inside? By all logic, a geopolitical black swan of this magnitude should have sent oil skyrocketing and gold into full safe haven mode global traders. Screens should be flashing a piercing, alarming red. Yet, eerily, the market is acting like a patient under heavy anesthesia, showing a chilling level of indifference. Oil hasn't moved, gold hasn't jumped, and even the VIX volatility index hasn't bothered to stir. Normally, for such a significant geopolitical event, the market would tense up instantly. But what truly alarms me isn't the event itself, it's the market's reaction. Look back at oil and gold, and you'll find a highly abnormal phenomenon. Prices have barely moved. Market sentiment is unnervingly calm, as if nothing happened. At this point, many people might instinctively breathe a sigh of relief, thinking the risk has been priced in and their investments are safe. But let me remind you, the most dangerous stage in financial markets is often not when panic erupts, but when everyone feels that the danger has passed. You might be thinking, if the market is this calm, does it mean the event isn't actually that important? That is currently the mainstream consensus among big capital. So let S follow the market, S logic for a moment to see why it thinks the impact is limited. Based on current information, the market's judgment is straightforward. Venezuela's critical oil infrastructure hasn't been destroyed. Core ports and oil fields are still operational. Furthermore, the country's current crude production represents only a tiny fraction of global supply. Combined with the fact that the 2026 global oil market is generally in a state of loose supply, a geopolitical event that doesn't directly hit production is unlikely to shift price trends immediately. From this perspective, the market's calm makes sense. But therein lies the problem. The market hasn't calculated incorrectly. It has simply calculated too shallowly. Do you know what that means? It means the market is only pricing in whether something is broken right now, rather than whether this event will change the risk structure for the period ahead. In finance, these two things rarely happen simultaneously. Think back, many truly profound market shifts don't start the day the news breaks. Instead, they often occur during a seemingly calm phase when prices aren't moving. The discussion is cooling down, and most people assume the chapter has closed. It is precisely then that risks begin to be pushed back, accumulating across a longer time dimension. So, in this video, I am not in a hurry to tell you whether to buy or sell a specific asset. What I want to do is break down one question when the market is this calm. Is it rationally digesting risk, or is it selectively ignoring critical variables? Only by understanding this will the future movements in oil, inflation expectations, and even internal shifts in the US stock market stop appearing as scattered noise. You will understand why, sometimes, a lack of price reaction is a signal in itself. Let S start with the line the market watches most closely and misjudges most easily. Crude oil. Let S see what oil has priced in during this event and what has been temporarily set aside. Oil is always the first asset people eye during these events because intuition says that any conflict involving an oil producing nation and military action should cause an immediate reaction. When it doesn't move, your first thought is that the impact is negligible. But this is exactly where the oil market is most prone to misinterpretation. Oil prices never just react to whether there is less oil today. Their more important function is pricing in future supply stability and the risk premium. This layer often doesn't manifest in the price immediately. The problem is that the market stopped at the first step. It calculated short-term supply and demand but failed to look further. If this type of geopolitical uncertainty isn't a one-off event but a recurring background variable, will it change the elasticity of future supply? Many people hear Venezuela and think of the world's largest oil reserves, over 300 billion barrels. It sounds staggering, as if production could surge the moment the situation stabilizes. But capital does care about ledger figures. It cares about reality when, at what cost, and how sustainably can this oil flow into the international market. The reality is a massive chasm between Venezuela's current production and its resource endowment. Long-term underinvestment, decaying infrastructure, frequent blackouts, equipment theft, and a web of legal and sanction risks mean that restoring capacity isn't something a mere political shift can solve. Even if everything goes perfectly, the industry consensus is that it would take years to see a significant recovery in output. This explains a critical, but often ignored phenomenon: international oil companies, those with the actual technology, capital, and execution power, haven't rushed in just because of political posturing. Capital's judgment of risk is far colder than market sentiment. They care about security, settlement, the legal environment, and the stability of future rules, not short-term opportunities brought by one or two events. So, the fact that oil isn't moving doesn't mean the market thinks the risk is gone. It means the market has made a dual judgment: short-term supply isn't broken, and they don't believe in a rapid, certain increase in mid-term volume. These two judgments create a very delicate state. Risk is delayed, but it hasn't been truly digested. If you still think this is just an oil market issue, you've likely missed the most important step. Energy prices never just affect the commodity itself. They drive inflation expectations and the entire asset pricing system. Let us follow that thread. When uncertainty in the energy system accumulates, it eventually finds an exit, and that exit is almost always inflation expectations. Energy isn't an isolated commodity. It's the cost floor of the entire economy. Transportation, manufacturing, chemicals, and the hidden costs of the service industry eventually reflect energy prices. This is why the market is truly sensitive to energy risk, not because of daily oil price fluctuations, but because of whether the path for inflation to return to target remains as smooth as previously imagined. Once the stability of the energy system is questioned, even if prices don't spike immediately, the certainty of inflation's downward trajectory is quietly eroded. Inflation expectations rarely make it into news headlines. They are more like a change in atmospheric pressure, slowly influencing the market's judgment of the future. And among all assets, the one best at sensing this change is T-stocks or bonds. It's gold. Many think gold is slow or even irrelevant during major events. This is gold's greatest misunderstanding. Gold isn't T for catching the first reaction. It reflects the change in market confidence regarding long-term certainty. While the market is busy crunching numbers and asking if an event can be contained, gold remains quiet. As long as the system is seen as controllable, gold has no reason to act. But once the market realizes a problem ends, TA1, off, but a recurring background variable, gold's role emerges. In the context of this Venezuela event, the fact that gold is currently calm doesn't mean it's dismissing the risk. It's waiting for a signal. That signal isn't a specific military action. It's whether the uncertainty surrounding energy, inflation, and policy paths continues to accumulate. If the oil market stabilizes and inflation continues to drop, gold won't move. But if energy risks keep resurfacing and make the disinflation process bumpy, shaking confidence in the future policy environment, gold's pricing logic will quietly shift. Gold isn't the starting point of a trend. It's a participant in the confirmation phase. It doesn't want to run, but once it starts moving, it usually means the market no longer fully believes that everything is under control. This shift often doesn't show up in indices immediately, but in subtle adjustments in asset allocation. So, do not interpret gold as current calm as nothing is wrong. A more accurate reading is that gold is observing whether the market actually has the ability to resolve the delayed risks mentioned earlier. Once a crack appears in that confidence, gold will likely signal it much earlier than other risk assets. If you're starting to realize that even slow assets like gold need to be re-examined, then you can just look at the indices when you turn back to the US stock market. We need to look at the internal structure of the market in an environment where uncertainty refuses to dissipate. Many investors use indices to judge the market. As long as the S&P 500 is steady and the Nasdaq hasn't crashed, they assume the environment is fine. But the real danger lies in whether the internal pricing logic of those indices is shifting. Recently, the US market's high levels have been built on a few key assumptions. Inflation will fall smoothly, policy will turn accommodative, and future uncertainty is manageable. Under these assumptions, high valuations and high expectations are tolerated. But once the uncertainties we've discussed, energy risks and skewed inflation paths, start to pile up, the pressure hit the entire market first. It will hit the assets most dependent on certainty. These assets share a common trait: valuations tied to future expectations, high sensitivity to interest rates, and earnings based on long-term growth assumptions rather than current cash flow. In a tailwind environment, they look brilliant. But when the environment shifts, they are the first to be scrutinized. Conversely, assets with stable cash flows and pricing based on current earnings rather than stories tend to show more resilience, not because they suddenly got better, but because when the market starts re-evaluating risk, stability itself becomes a scarce resource. This is why you might feel a gap. The index hasn't T-dropped much, but your account feels increasingly painful. The problem isn't necessarily that your direction was wrong, but that the market has begun to distinguish between different assets' risk tolerances, and you happen to be standing on the sensitive side. From this perspective, the real impact of events like the US raid on Venezuela isn't a sudden shock to the market. It's the acceleration of an existing process. The market is starting to reprice certainty. It is slowly filtering out who can continue to enjoy a high premium and who needs to return to a more realistic valuation framework. If you agree with this logic, then the most important thing for us as investors isn't to predict the next market move, but to adjust how we view the market. First, re-examine the source of certainty in your assets. Ask yourself, are these assets supported by stable cash flows, or are they reliant on future assumptions? In an environment of recurring uncertainty, the latter is far more fragile than you might think. Once the market re-prices certainty, this gap will widen rapidly. Second, be wary of logic that only works in a tailwind. Many investment strategies have worked recently because of smooth disinflation and a friendly policy environment. If those premises falter, you must ask if your strategy can still stand. Third, deliberately leave buffer room in your portfolio. This doesn't necessarily mean a massive overhaul of your holdings, but rather ensuring that if the market rhythm suddenly changes, you aren't forced to make decisions at the peak of emotional distress. Many investment errors aren't about wrong judgments, but about being forced by the environment to make a mistake, because there was no room for error. You will find that truly mature investing isn't about hitting every mark. It's about always having room to adjust when the environment changes. When you view the market this way, short-term fluctuations become less important. To summarize, this isn't just about whether oil will rise, gold will surge, or the stock market will crash tomorrow. It's about a longer-term question in an environment where uncertainty cannot be fully dispelled. What is keeping your assets alive? If you change nothing, nothing may happen in the short term. But once the market truly begins to reprice, the adjustment often comes faster and more concentrated than you imagine. So, instead of chasing the next headline, think clearly now. When the environment changes, will you still be trying to understand the market using old assumptions?